Hi guys, welcome to the second video of the channel. And in the previous video, we talked about what investment banking is, the different type of groups in a product group, coverage group, your what specializations they have, whether it's M&A, DCM, ECM, just how the bank is also split up, how they make money, just the basics of what you kind of need to know before heading into, I guess, investment banking, just a little bit of basic knowledge before we can go into a little bit more of the technical stuff for sure. But today we're going to be talking about the most important one, in my opinion, the foundations of finance. This is kind of like your backbone for all these future concepts as well, because a lot of the stuff, whether it's making a DCF later on, and I guess just having a basic understanding of what the time value of money is, discounting, all that stuff is super important later down the line. And I just wanted to touch on it through this video. So this is chapter 2. And if you haven't seen the previous videos, please go ahead and watch them. And I feel like they should give you a pretty decent understanding of what investment banking is. But right now, we're going to start going into the more technical stuff. So let's talk about time value of money. So time value of money. Say, for example, your friend offers you like $100, right? Let's write this down. Your friend offers you $100 today. And or they offer you $100 in 1 year, right? Which one would you take right now? You would probably take the $100 today because everyone does, but have you? There's a little deeper understanding on why you could take it right now rather than like later. Number one, you can invest it. Money now earns a return. $100 today kind of grows before next year even arrives. So you can, number one, just invest it. Number two, prices rise. And you may be thinking, how do price rise? It's just a common market phenomenon, inflation, right? So inflation kind of eats value. The same $100 kind of right now buys less a year from now. So that's there as well. And number three, the future is risky. You, me, even like no one can tell what's going to happen in the future. And a promise for next year might break because the value of money may decrease. So always, if someone asks you in an interview, because it is a common question, I've seen it before, would you take money $100 from now or $100 in 1 year? Just choose now, because money now is always worth more than money in the future. And time value of money means the same amount of cash is worth different things at different times. So sooner is better. To compare money across time, you move it all to one point in time first. The single move powers every valuation method also in this guide. So whether it's discounted cash flows, because you're going to be taking your current cash flows and just you're going to be taking future cash flows and working around each of them with your discount rates and just seeing how that money transfers. And you can see that happen pretty nicely when it comes to DCFs. So the time value of money can be seen in action there. So let's break this down here. And our next concept we're going to be talking about is compounding and discounting. So if you're moving money in any direction, so you have your compounding and then you have your discounting. So money either moves in two directions. You can either move it forward or backward. And if you push it forward, you can see what it grows into. And if you pull it back, you can find out what a future amount is worth today. It's basically the same idea, just different, I guess, directions. So compounding and discounting, right? Let me draw like a quick diagram. So today, just to keep going on the $100 example, if you have today, you have $100, right? And this is your present value, PV. If you compound forward, right? You compound forward, then 3 years, this is going to be worth, let's just say, $133.10 in future value. That's what the money is worth then, not right now. So you're basically compounding it, let's just say compound by, I think it's 1.1 per year. But if you're discounting it back, right, you're discounting it by 1.1 again, right, per year. And at a 10% rate, $100 grows to $133 over and 10 cents over 3 years. And if you flip it, $133.10 in 3 years is worth $100 today. So they're basically the same thing, just going in different directions. And this is just a key concept to understand before we go into any valuation stuff, most importantly. So let's split that up. So that's our next concept that we covered. And to kind of, you may be wondering, how do I find these? How do I find what the future value is, or how do I find what the present value is? And there's two main formulas. Let's talk about future value first, right? Your future value. What you do here is it's basically your present value, right, times 1 plus your rate per the period, right, to the power of n, which is the number of periods. So you basically multiply by the growth rate once for every year. And when money snowballs, because each year you earn a return on last year's return. That's basically how this works. So PV is your present value, right? You have your present value here. And R is your rate per period. Or in this case, it's just the discount rate or return. And your N is going to be the number of periods, right? So a bigger R or a longer N just makes that factor bigger, which makes today's value smaller. So I'd say risky money is worth little now. That's basically the main concept at hand here. So let's scroll down a little bit, split this up, and let's go into present value. This is future value we covered. Present value is super similar. All we do here, you can go back and forth easily, but you just take your future value divided by your 1 plus your rate per period to the power of your amount of periods. So basically you divide by the same factor to strip out that growth that you did not earn yet. And this concept is discounting. So this is called discounting because you're basically shrinking. And this is kind of the heart of a DCF. So this is kind of a main concept that you kind of need to know for a DCF, right? So that's basically this formula right here. So let's move down and I guess I have to add a new page. Okay, let's add a new page and let's do a practice problem. So let's just say you receive $500 in 4 years. Discount rate is 8%, right? So how much is it worth today? So let's start off with our formula, right? You have your 1 plus your discount rate to the power of 4 because it's 4 years. And let me see if I can do this in my head. So 1.08 times 1.0. It should come out to, I think 1.3605. Yeah, so that's basically what you have, and then you just divide because you're discounting, right? So you divide 500 divided by 1.3605. Pull out the calculator for this one. You get 367.51. So basically, if you interview, someone asks you this, you just say, it's basically worth about $368 today. The future 500 loses roughly a quarter of its value once you kind of pull it back 4 years at 8%. So you basically have your future, like how much you're getting in 4 years, and you're basically seeing how much that is currently worth today. So you're getting $500 in 4 years, and you're seeing that it's actually worth $367.51 today. So that's there. And next concept that we're going to be talking about, super simple. We learned this in 6th or 7th grade. Simple and compound interest. Just retouching on it because this is a 0 to hero course. We're going from the beginning. So simple and compound interest, right? It's basically the interest is the price of using money, and it comes in two forms: simple, compound interest. So let's build out a little table here. Build out a table. Let's just say here you have your year, right? And here, split this down here. So here you have your simple interest. Let's say simp. Here you have your compound interest. And let's just say this is 10% on, you can just do $1,000 to keep it simple. And here we can do 10% on 1,000 as well. So right there. So your starting is going to be just your principal. So you're just your 1,000. And then here is also, it's going to be $1,000 right there. And then if you go from year 1, let's just say year 2, year 5, year 10, from, split this up like this. Oh shoot, my handwriting's terrible, bro. Okay, so here, if you do it out at 10%, this is going to be 1,100. This is going to be 1,100 as well. If you do it at 2 years, this is going to be 1,200. This is going to be 1,210 because it's compound interest. Here it's going to be 1,500. It's going to be 1,611, I think. Yeah. And then here it's going to be 2,000. And here it'll be 2,594 is what I think. Yeah, 594. So simple interest pays only on the original 1,000. Compound interest pays on your interest as well. That's basically the concept you have to know here. So it pulls ahead further every year, and finance in general always just means compounded. Finance is a very future-looking concept. In accounting, you're going to be looking at past assets, their value on them, all that stuff. And in finance in general, you're going to be looking very future directed, and that's a super important concept to just kind of understand. So let's go ahead and we can just delete this stuff for now. Right, so let's just talk about, what could we talk about? We can talk about the discount rate a little bit, right? So discount rate, because you may be wondering like what this is and all that stuff. So the discount rate is not random. It stands for like the return an investor demands. So let's write this down. So this is the return an investor demands to take on the risk of an investment. Very simple definition, but that's what it is. So safe cash flows kind of get a low discount rate. Risky cash flows get a high discount rate. And when you value a company later, choosing this rate is probably the single biggest judgment call you're probably going to make. So it's a pretty important, crucial concept to understand. We'll just start that. And people treat the discount rate and growth rate as separate things, but they're linked. So a higher discount rate lowers value, but a higher growth rate raises value. In valuation specifically, from what I've noticed, small changes in either one swing the answer a lot. So interviewers test whether you feel that sensitivity. So I say always know which way a number pushes value. That's super important because that's a common trap. So yeah, that's an important concept. So let's go ahead and give this. So next thing we're going to be talking about is going to be perpetuity and annuity. So discounting one payment, as we've seen, is pretty easy. Real investments pay many times. So 2 shortcuts to save you from discounting hundreds of payments by hand show up in valuation. And the 2 shortcuts you can use is perpetuity and annuity. So let's talk about perpetuity, right? So perpetuity is a fixed payment that lasts forever, and you basically value it in one line. So your present value is equal to your payment divided by your divided by your R, or your rate. So a $50 yearly payment forever at a 10% is worth 50 divided by 0.10, which is equal to 500 today. And the DCF kind of just leans on this idea heavily. And let's talk about growing perpetuity, right? This is basically a payment that grows at a steady rate, G, in this case, forever. So if this is basically your normal perpetuity, and this is going to be your growing perpetuity, right? So your growing perpetuity. So this formula is going to be present value is equal to your payment, right? Divided by your R minus your G, so your rate minus your growth, the growth rate. And this is, I think, from what I remember, from what I've read, is called the Gordon growth formula. Gordon growth formula. And you're going to use it to value a company's cash flows past the forecast window. And always know that your R has to be bigger than your G, or else like the math kind of just messes up. So that's something important to know. So let's delete this now. So that's the concept there. Just going through this super quick, but these are kind of the basics that you kind of need to know to learn anything further. So let's talk about, let me think. We can talk about risk and return. Risk and return. So let me draw out a quick diagram for you guys. It's a chart. So let's just say this is your expected return, and this is going to be your risk. So right here is going to be the lowest risk, going to be highest risk, basically how you graph, but your highest return, right? So let's just say your government bonds are going to be sitting right here. Say government bonds. They're going to have low risk, low return. If you go to like a blue chip stock, right? Your blue chip stock, it's going to be in the middle area. If you go to a smaller company, right? Let's just say small company, it's going to be on the higher end of the risk, but also a higher return. And if you go to a startup, for example, you're going to have a lot of risk, obviously, but you're also going to have a higher expected return. So riskier bets sit higher and to the right. Government bonds are, like I said, close to riskless, so they pay the least. A startup could soar or go to zero, so investors demand a much higher return to fund it. And basically, the main idea to understand is that no one takes on more risk for free. To accept a bumpier ride, investors demand a higher expected return. And it's a pretty obvious concept, but just something to remember when you're going into this a little more. So let's just delete this for now. Since we did touch upon risk and return, I feel like there's two terms for me to address that are pretty important. So when you go into valuation, and a lot of these problems later on in investment banking interviews, they're going to ask you about some stuff that consists of a lot of financial jargon. So it's important to understand these terms. So we have your risk-free rate. What is a risk-free rate? It's basically the return on the safest asset around. That's basically what it is, super simply. It's usually a U.S. government bond because the government is trusted to pay. It's the return on the safest asset. Safest is the key word. And we can just say an example is a U.S. government bond. Right? You have your U.S. government bond. Next important term to know, risk premium. So what this is basically the extra return an investor wants on top of the for taking real risk, right? Basically here, it's just reading it out again. It's the extra return an investor wants on top of that for taking the real risk. So it's just a premium that you're paying for taking that risk, just being like, this is just an extra amount that it's just how it works at premium. You're going to see premiums everywhere. So basically, if you add them together, if you add these two together and you get the return on investor demands, which is exactly the discount rate you plug into your formulas. So your risk-free rate, we'll just say RFR, plus your risk premium, sorry, let's delete this, and your risk premium is equal to your discount rate, right? That's there. If you add them together, you find out your discount rate, and this kind of bridge carries you straight into the cost of capital in like later chapters, because if you did watch like the first introduction video on what we're going to be talking about, cost of capital and the corporate finance stuff will be in one chapter by itself. So let's get rid of this. And we can, I guess, go off with some practice problems, because that's going to be the end of the chapter. Just the basic finance stuff and fundamentals to know. So let's start off with like something like an interview question. So in this interview question, they're going to ask you, would you rather have $1 today or $1 in a year, and why? We talked about this in the beginning of the videos. Take a couple of seconds to kind of just think about it, and then we'll talk about it. So if I were in an interview, I'd say there's 3 main reasons why I would take $1 today. Number 1, you can invest it. Number 2, inflation erodes it. And number 3, the future is uncertain. Then I'd probably push away and just say this is why we discount future cash flows to value a company. And you also, in this case, since you mentioned that, you show that you understand kind of the whole foundation of how finance is and the time value of money. Again, so concept number 1, time value of money, right? Number 2, let's just say, say you have not 100, we can just do $1,000. What does $1,000 grow to in 2 years at 10% compounded? Take some time and just think about it, and we can resume. Okay, so $1,000 is going to be multiplied by 1.10 times 1.10, because it's 2 years. This is 2 years. Sorry, that is terrible. But it's a terrible bracket. But yeah, it's 2 years. So you're going to be getting $1,210. And the extra $10 over simple interest is the interest you're earned on year one's interest. That's basically how compound interest works. So let's look at question number 3. You can say, if the discount rate rises, what happens to the present value and why? Right? What happens to present value and why? Basically for this, please pause it if you haven't already, but I'm going to continue. For this, the basic answer is present value falls. This is because a higher rate makes the discount factor, because in the formula it's 1 plus r to the power of n, and it makes it bigger, and dividing it by a bigger number gives a smaller value today. Higher risk means future cash is worth less now. That's basically the concept. So next question. Let's just say a project pays $20 every year forever. At a 5% rate, what is it worth today? Sorry if I didn't write this down. 5% rate. So at a 5% rate, what is it worth today? Pause the video. Okay. If you were given a 5% rate, that's basically 0.05, and you do 20 divided by 0.05, and you get $400. And once again, this is the perpetuity formula if you want to go back in the video and look at that a little more. And last question, why does a startup have a higher discount rate than a government bond? So why does a startup have a higher discount rate than a government bond? Pause the video. Okay, so basically we talked about this in that chart, in the graph that I made, and basically this is because the startup is far riskier, so investors demand a large risk premium, We talked about risk premiums as well, on top of the risk-free rate. And that larger required return is a higher discount rate. That's basically all that is. So pretty short video. We covered everything for the fundamentals and foundations of finance that you need to know. Obviously, you're going to learn more from your university class, from your professors. They're going to give you a lot of more information, detail that I think is super interesting. But I'd say this is kind of the basics you need to continue into, whether it's the accounting portion or the DCF portion. And we're going to be touching on these concepts a lot, just referring back here and there. And that's basically it for this chapter. Thank you so much.